and also commercial banks and larger funds. So for some asset classes, as I said earlier, I think that's a real issue, the refinance risk moving forward and how much debt is coming due. My personal opinion is multifamily with the stability in it. Everyone needs a place to live. It's the most important bill you pay every month. It's the most stable asset class in commercial real estate. There will be money, in my opinion, chasing that, regardless of the situation and throughout the next, 5 or 10 years when the existing debt does come due.
Was answered. Okay. Any other questions, sir?
Yesterday Goldman reported in the journal that they were purchasing 4,000 units of low-income housing. I was trying to make sense of the deal. I was wondering if you guys could speak to it.
I read the same article. I'm not sure I understood what their strategy was on that. I don't really know.
I didn't see the article, and we don't buy affordable, so I'm probably wrong.
Okay.
That could be a tax credit type investment also.
Sir?
I know you guys gave your outlook for going forward 2010, 2011. What about for New York City rent stabilized buildings where they have the New York City guidelines for rental increases? Are you still going to keep them flat, or in those buildings are you going to increase according to how the city is increasing rents? Stabilization rents?
Well, every year the Rent Guidelines Board meets and sets the allowable increase for your stabilized rents. The 25-year historical average is, I think, 3.4%. There's never been a year where they held it flat. It's generally tied to, it should be tied to the inflationary costs of landlords' operating costs. Every year our taxes go up. Every year our water costs go up. Every year, utility costs go up. So, you can look at a pretty good data set and say with relative confidence that it's going to be somewhere between 2 and 4% generally. And if we have spikes in fuel costs again, the landlords can make a great case that it should be higher. If fuel costs stay low and the city keeps taxes low, which I guarantee is not going to happen, the tenants will make a great argument that it should be on the lower side. But there's never been a year where they've reduced rents. And look, generally for most stabilized apartments, you're very close to covering on the actual stabilized unit. You're very close to covering your operating costs. So, again, that goes back to my point earlier, which is you have to incentivize landlords to keep up the quality of their housing stock. Otherwise, the city will be in a lot of trouble.
For us, we're noticing a few trends. We're still able, for renewing tenants, we're still able to generally obtain the increase, the 4%, now 3% increase. The issue becomes when you have a roll and what sort of increase you can get in this market. And that remains to be seen. I think there's some downward pressure there. And then, of course, you have your collection issue, which is increasingly creeping up to becoming a little bit of a problem. But by and large, look, on a relative basis, if you net that all out, you still have a rent roll that is generally increasing, but increasing more slowly than it did previously, at least for us. Well, what we're talking about is on a net basis, you may be up a little bit or flat. This is in the low end rent regulated, which is very different from what we've got outside of New York City. This is just a New York City lower end rent stabilized phenomenon, at least for us. So NOI maybe grows a little bit, but there's pressure.
I think we have time for one more question, sir.
Well, I think frothiness today is for the core asset that is so well located, and there's not a lot of them on the market. I think that's another issue, and I primarily focus on the West Coast, but I do oversee our East Coast operation, and On the West Coast today, I think from last I saw, there might be 6 to 8 institutional deals on the market today, not including Texas. And although Dallas and Austin don't have a ton on the market either. So the core deals are trading frothiness from a cap rate standpoint because they've come from a 7 now down to a 6 or sub 6. And the per unit looks good. It's a cheap per unit. But if I bought my asset in the last 2 or 3 years and I don't really buy core, so I can't, I have 1 or 2 core deals, which I am going to sell because of the frothiness. It's hard to get out of anything that you've bought in the last couple of years, even with the frothiness, because we paid low cap rates in 05, 06, 07, and like everyone said, our rent rolls have declined. So if I paid a 5 or 5.5 cap because I was going to rehab this property and increase my rents, it was going to become a 7 cap. Well, now that's a 5 cap, and even though people are paying 6 caps and it's frothiness, I'm still underwater, so it's hard to get out of it today.
I'll say one thing about the frothiness. The frothiness may be on the buyer side in the core opportunities. It may not necessarily be on the seller side, okay? So someone who's selling, say, a core New York City market rate apartment building today, maybe they're getting, I don't even know, say a 5 cap today, 5.5 cap today. Okay, they may have bought that 3 years ago, 4 years ago at a 3 cap. So they're probably losing money. So it's a buying opportunity for the buyers, but not necessarily for the sellers. So I don't know if it's all great news.
One quick stat, and then we'll let Mason, then we're going to wrap up. The last 3 months across the country, per Real Capital, there were 75 on average deals trade each month across the country. 2 years ago, that average was 375 per month. So that gives you an idea. The frothiness is, like what Mark said, there's a handful of deals out there, and every deal guy in the country is going to put a bid on because it allows them to understand the pricing. That's what it does. If you look at the 30-odd bidders in a lot of these deals, there's only a handful of guys who are actually going to, can and will close. A lot of the guys are just kicking tires, one, to understand where the market is. So, Mason? We'll wrap it up.
Yeah, just a little bit on, because that question I think really captures, just going back to that question that was asked. The underwriting got so out of control at the peak. And so deals were being underwritten on a 0 coupon basis for 10 years, and your pop, you had no cash flow, and your pop was somewhere down the road, and it was on hockey stick fundamentals, and cheap debt fueling it. And now we've come back to a world of a little bit back to basics. So people want some traditional things. They want some cash flow. They want to underwrite in without some sort of crazy ramp up at the end. And so when you layer that on, new underwriting with pressured fundamentals, and you apply sort of a new reasonable cap rate, which is much more in line with the historical average, all of a sudden, as you said, if you bought something 2 or 3 years ago, it may be a good time to be a seller, just generally speaking, in terms of the amount of bids that are out there. But you're underwater, as you said. You're underwater. So, I'm sorry, I didn't answer the other question.
That's it. Thank you, everybody. Thank you, panelists.